Most investors are cheering a 1.9% revenue climb, but my forensic audit found the hidden pressure on the yield spread that is quietly eating your dividend safety. We are looking at Great Eastern, Venture, and Centurion Accommodation REIT today. If you are relying on these names to defend your SRS or CPF ordinary account against firming inflation, you are currently operating without a stress test buffer. Let us break down exactly where the yield spread is thinning before the broader market reacts. I have been watching these blue chips for a while, and the numbers that finally made me sit up were the interest coverage and gearing figures. My job is simple. Even if the balance sheet is not, I rate the numbers that the headline skips: the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. Looking at the hidden pressure across the market, the narrative might be focused on the top line beat, but the forensic reality tells a different story. The T-bill is sitting at 1.40%. The buffer you thought you had is disappearing. The market loves to celebrate revenue growth, but when you look under the hood at the yield spread, it is quietly thinning out. If you are building an income portfolio, you cannot afford to ignore the gap between the risk-free rate and your dividend yield. Relying on a shrinking spread means you are taking on equity risk for bond-like returns. In this economic climate, that is a direct threat to your long-term capital preservation. Looking at the hidden pressure across the market, the narrative might be focused on the top-line beat, but the forensic reality tells a different story. The T-bill is sitting at 1.40%. The buffer you thought you had is disappearing. The market loves to celebrate revenue growth, but when you look under the hood at the yield spread, it is quietly thinning out. If you are building an income portfolio, you cannot afford to ignore the gap between the risk-free rate and your dividend yield. Relying on a shrinking spread means you are taking on equity risk for bond-like returns. In this economic climate, that is a direct threat to your long-term capital preservation. Turning to the macro picture, the STI is currently oscillating within the 4,900 to 5,050 range as psychological resistance holds post-relief rally. The 6-month T-bill is at 1.40%, with yields continuing to edge lower. The 3-month SORA at 1.07% suggests we are approaching the bottom of the easing cycle. The iEdge S-REIT index sits at 1,059.1. The major macro event is Brent crude remaining volatile above $119 per barrel. This is driving AMAs to preemptively tighten policy and lift inflation forecasts to between 1.5 and 2.5%. That sets a tough backdrop for yield-focused assets, and it is the backdrop every name in today's audit has to survive. We start our audit with Great Eastern, which has officially triggered a watchlist warning. The raw fact is that net profit rose 0.2% to 346.3 million Singapore dollars, underpinned by insurance profits despite a less favorable investment environment. The problem is that 0.2% sits far below Great Eastern's own mid-teens annual average over the last 3 years and completely misses my target of above 5%. Even more concerning, while the current yield of 4.91% technically clears my 4.7% minimum hurdle, it barely scrapes by. Against core inflation now at 1.7%, this quarter represents effective stagnation for your capital. Peeling back the layers of risk for Great Eastern, the peer context shows that SGX listed Prudential reflects broader regional volatility, while unlisted competitor Singlife targets higher growth margins in the protection segment, making this 0.2% a structural outlier. The forward scenario is where it gets dangerous. A 10% decline in investment income could wipe out the marginal insurance profit gain, potentially dropping net profit by 30 million Singapore dollars or more. For a 60-year-old retiree in Toa Payoh managing an SRS drawdown, this growth represents a real-term loss against headline inflation of 1.8%. Steady is just a polite word for stagnant. When your profit cannot outpace inflation, your capital is shrinking in the wash. Moving to our second name, Venture Corporation is flashing a massive yield trap alert. The company reported a net profit of 56.3 million Singapore dollars on revenue of 628.5 million Singapore dollars. That is up 1.9% year-on-year. But here is the forensic whisper. That 1.9% revenue lift barely covers the 1.7% MS core inflation floor. In a boom cycle, this is not growth, it is drift. Earnings per share came in at 0.195 Singapore dollars, representing a microscopic 0.9% growth. The market is obsessed with the artificial intelligence infrastructure label, but the numbers tell a much more boring story. Breaking down Venture's forensic layers, the peer context is alarming. Sector peers like AEM and UMS typically show higher beta in semiconductor and artificial intelligence cycles. Against that backdrop, Venture's 1.9% looks structurally sluggish rather than conservatively positioned. The forward scenario shows that a 10% shift in global AI spending would impact revenue by roughly 60 million Singapore dollars, especially if a Brent crude shock above 130 US dollars hits logistics costs. The wallet impact is clear. A 45-year-old HDB owner in Jurong supplementing a salary would see this 0.9% earnings per share growth as entirely insufficient to sustain long-term dividend hikes, making this a risky hold for anyone relying on consistent income. The forensic verdict on venture is that artificial intelligence infrastructure demand is merely the headline, but the 1.9% revenue growth is the actual engine. With cost of living anchors like electricity tariffs rising 2.1% this quarter, this stock is not even covering your household overhead. We are looking at a classic yield trap where the nameplate says tech, but the engine performs like a utility. If the stock continues to trade at a premium to fair value while growth stalls, it becomes a severe liability. Activity is simply not the same as progress. Shifting to the real estate space, Centurion Accommodation REIT is a price-dependent watch. The operational debut is undeniably strong. Net property income reached 37.5 million Singapore dollars, up 2.4% against the prospectus forecast. And revenue beat the forecast by 2.7% to hit 52.5 million Singapore dollars. The balance sheet metrics are clean. The ICR clears Zone 1 at a solid 6.02 times, and gearing is at a healthy 31.0%, well below the 35% ceiling. The financing cost of 3.57% is also a positive delta against the forecast. However, the current yield at current market pricing sits around 1.57%, which completely fails my 4.7% minimum hurdle. Looking at the full picture for Centurion Accommodation REIT, the structural strengths are clear when compared to CapitaLand Escort Trust. This business boasts a superior gearing and ICR profile. The worker dormitory segment benefits from a government-regulated demand floor anchored by Singapore's construction workforce, driving PBWA occupancy to 94.0%, which is just marginally below my 95% prime threshold. PBSA occupancy is robust at 98.6%. However, the forward risks are real. A 10% weakening of the British pound and Australian dollar against the Singapore dollar would reduce NPI by 2 to 3 million Singapore dollars. And with 40,200 new dormitory beds scheduled for delivery across Singapore in the next 2 years, that supply risk could soften occupancy further. The final verdict on Centurion Accommodation REIT is straightforward. It is a good business at the wrong price. I am not buying the yield story until the math clears 4.7%. The operational report card is hard to fault, but the forensic problem is entirely on the price side. The market has bid this up to a point where the yield sits at roughly 1.57% below the T-bill, below my floor, and below any defensible income standard. This is not a yield play today. It becomes one only if the unit price corrects toward a level where the projected financial year 2026 distribution of 115.4 million Singapore dollars across 1.72 billion units starts to make sense. I am preparing a deep dive review of Centurion's results, so watch out for that piece coming right up in another video. When we compare the analyst chatter against my forensic filter, the disconnect becomes obvious. Institutional analysts are generally positive on venture due to its artificial intelligence positioning, but my filter says this call fails the 4.7% minimum yield hurdle. If the stock price does not re-rate to reflect the actual 1.9% revenue crawl, market optimism is not a forensic argument. Similarly, there is positive institutional sentiment on Centurion Accommodation REIT due to its NPI outperformance, but under my filter, this only holds up against the 3.2% floor if the currency tailwinds are not used to mask a potential rise in debt servicing costs. You have to strip away the optimism and look at the raw mechanics. Let us look at the yield spread calculation for Centurion Accommodation REIT. The current market yield is approximately 1.57%. The T-bill is at 1.40%. That gives us a nominal risk premium of just 0.17%. That spread is so thin, it offers no meaningful buffer above the risk-free rate. It sits far below the 4.7% forensic minimum hurdle. My stress test buffer applies a conservative floor of 3.2% plus 150 basis points of mandatory risk premium. The 3.2% floor holds regardless of where T-bills sit, because we audit for the storm, not just the sunny day. The reality of this market is that the window closes fast, and the difference between a sanctuary asset and a yield trap is often decided in a single trading session. If you are tired of being exit liquidity and want to get the full breakdown before the free version drops, Iggy's elite investors get 0-day access. You get the full red zone watchlist and institutional grade cheat sheets at the moment the setup is live, not after the market has already priced it in. For 9 Singapore dollars a month, less than a coffee and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. The link is in the description. Looking at the bottom line for today's audit, the verdicts are clear. For Great Eastern, the 0.2% profit growth is a forensic flatline that fails to provide a real-term buffer against rising costs, firmly placing it as a watchlist trigger. For Venture Corporation, while artificial intelligence demand is the story, the 1.9% revenue growth is the reality, and the yield spread is thinning too fast for comfort, a definitive yield trap. For Centurion Accommodation REIT, a currency-boosted beat is welcome, but we need to see organic growth once the Singapore dollar near slope steepens. Watchlist trigger until the price corrects. The market is currently pricing in a soft landing, but when I look at the cost of capital benchmarks in Clementi, where bank mortgages are hitting the high 1% range, the margin for dividend error is completely gone. If your assets are not clearing the 4.7% hurdle, you are not investing, you are subsidizing the bank's balance sheet. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MES licensed financial advisor before committing funds.